Excel accounting practice problem. Make loan payments according to an amortization table. Get ready, because we're going to excel. Here we are in our Excel worksheet. In prior presentations, we constructed the worksheet from a blank sheet, and now we're going to continue to enter transactions into it. If you have access to it, there's two tabs on down below, the example tab and the practice tab. The practice tab starting out where we left off last time, the example tab being in essence an answer key. Let's take a look at the example tab now. Last time we put together an amortization table so we can then record our transactions related to the payment of a loan payment, breaking out the interest and the principal. Now we're going to be entering the data for them. We're actually going to enter two transactions, kind of jumping from the beginning to the end of the month, so that we can get an idea of the differences between the transactions, the difference between the breakout of the interest and the principal, and what kind of problems that might cause as we enter the data input, what kind of solutions we might have to it. Let's go back to the practice tab, and we're going to do our data input for this. To do the journal entry, let's first hide some cells to go all the way so we can see our amortization table. So I'm going to put my cursor on column M, and I'm going to drag all the way to the right till we get to our amortization table, which is way out here into this cell right there. We're going to go to EO, right click and hide, right click and hide that stuff. So there we have it. That should be good enough. So now we're going to be posting this first transaction. So here's our amortization table. I'm going to make this first transaction green, the first payment that we're going to make. We're going to imagine that this is the first payment that we're going to be making on the loan. That's going to be the $72,000, just so we get some practice with our amortization table up top. Now, the problem with the loans, there's a couple different things that we have to take into consideration. As we talked about before, one issue is that this loan is 5 years long, so we have a short-term portion and a long-term portion to it. But for data input purposes, I don't really want to break out the short-term and long-term every time. So as we talked about before, typically I would recommend breaking that out periodically, basically on an adjusting entry type format, breaking out the current and long-term portion, which we'll do later at a later time. We also might have a situation where you have multiple loans, where you could put all the loans into one account or break them out into multiple accounts. For presentation purposes on the financial statement, you typically want them in basically one account, but for data input, you probably want separate accounts that are single accounts so that you could tie them out to the loan schedule. So that's the second problem, which we would basically do. I would recommend an account per loan for data input and then grouping them together, possibly with sub-accounts in accounting software for presentation purposes. Then we also have the issue of, well, every time I enter a payment, there's going to be three things involved instead of just two accounts. That makes it a little bit more difficult to do data input if, for example, I want to just do an automatic bank feed transaction in something like online software, because I cannot as easily memorize the transaction due to the fact that there's three accounts impacted, and those accounts will actually change from payment to payment. Even though the payment won't change, the interest and the loan reduction will change. So one way that you can deal with that is that you could try to say, on the bookkeeping side, I would like to make things as easily as possible by simply recording the payment possibly just to one account, such as the loan reduction, then allow your CPA firm during the adjusting process, or your tax preparer, or you yourself on a monthly basis or yearly basis, to adjust the interest and the principal and break out the short-term and long-term if necessary, depending on your needs, periodically with the adjusting entry process. That's another option that you could have that can make the data input very easy, and then you just adjust it periodically, monthly or yearly. Another option you can have. But we're going to basically use our amortization table to enter the transactions properly in accordance with the amortization table as we go. So what will this look like then? The transaction, let's pretend the first payment was on 2/1. And what we're going to have involved then, we know the checking account is going to go down. I would typically put that on the bottom. I'm going to have three accounts affected. So I'll do that first because it's the easiest one to think about. But I'm going to put it on the bottom because logistically, you typically want the credits on the bottom. So I'm going to say the checking account's going to go down. It's going to go down by the payment amount. I'm going to say credit of the payment, and I'll just pull the payment of that 1359 about. Remember, it is rounded. There are pennies involved in it. So that's pretty straightforward. And then you got to break out between the interest portion and the loan portion. So in other words, how much is the loan going down by? The loan, you'll see, is a credit balance account over here at $72,000 on the books, but it's only going to go down by, as we can see over here, it's only going down by the 300 about. And that means the difference has got to be going to, actually the loan is going down. Hold on a second. The loan's going down by the 1059 about. And the interest then is going to be the rent on the money, the difference, which we could get by negative sum. The plug formula will be at $300, which matches the $300 here. So I need another account down below, which is going to be interest account. I'm going to put it on the bottom, even though in alphabetical order it might be up top, because sometimes in accounting software, sometimes they put the interest at the bottom because you might put it outside of normal operations since it's a financing type of thing. So you have a subtotal at the bottom. So we're going to practice doing that and put it at the last account. And we'll see that in more detail when we create the financial statements and update the financials. So on the trial balance, I'm going to select these cells, right click and insert, and shift these cells down. I'm going to highlight the ones above them and use our paintbrush to paintbrushy them and select them down. So then this is going to be interest expense, 0, 0 to start out with. And let's double check that our totals are totaling up the way they totally should. This one is not, so I'm going to add the interest expense there, dragging it down. I'm going to select these two totals and then put our autofill and drag them across to make sure that they're all totaling up the way they totally should. So then we're going to go back up top and say the interest is going to be equal to the interest down here, the interest expense. There we have it. And then let's indent the checking account. So there's going to be our transaction. Let's post it out and see what happens. So we're going to go interest expense down below. This is the rent on the money. This is basically us having to pay rent for the purchasing power of the money, equals that interest expense. It, of course, has an impact on the net income. Then we're going to go to the loan payable. Loan payable is in I-15 equals. We're going to scroll up to the loan amount of the 1059. So we had the 2029. Both sides are now going to go down. That's the wrong area. Hold on a second. We're on I-14, the loan payable, 1059. Now both sides are going to go down on the balance sheet to the 70941. The difference is down here on the income statement side. Notice that this transaction is the only thing we have on the income statement accounts. If we're talking about just February, because we closed out the income statement. If we're talking year to date, January and February, then of course we have all the activity here. So we have the differences in the income. We have a loss so far for the period of February because we haven't recorded any revenue yet. And for the year to date, January and February, we're at income of the 7,000 to 127. Okay, so then we're going to go back up top and say the cash, finally, checking account. Both sides of the checking account are going down because this is a balance sheet account. It's only going to be different down here on the income statement side of things because of the closing out process and, of course, the equity, the blue section because of the closing and timing accounts. All right, so there we have it. Now let's do it again. I'm going to record it. I'm going to jump to the end of the month just so we can see the difference between these two transactions. And I know this is a little bit funny. This will put things out of order in our general ledger and whatnot. But we want to see what's the difference if I was to do another transaction and what kind of complications would it cause next time I make a payment. So I'm going to ungreenify this first one here. Going to ungreenify that one, making it blue. If you don't have that blue right there, I'm going to pick it up standard. That's the Excel is Fun Guy blue. So that's what we use here because of his excellent work in contributing to my accounting and or Excel stuff. So then we're going to go down and we're going to say that this is going to be same transaction down here. Interest expense. And then we got the loan payable again. Loan payable. And then we've got the checking account. Then we've got the checking account, but I can't memorize the transaction as you might want to do in something like accounting software. I'm going to indent, because even though the payment's the same, I'm going to say negative of the payment. That's the same. The breakout of the interest and principal is not. The loan reduction is going to be equal to the 1,063 about, and the interest will be the negative sum plug formula if you want to use the negative sum, which you can also pull from the table of about that 296. So this is the issue, because one, we've got 3 accounts impacted instead of 2, which is generally the case when you write a check or decrease the checking account. And 2, they're not going to be the same. So that really distorts the ability to do the bank feeds and whatnot and memorize the transactions if that's the kind of system you're setting up in an accounting system. So again, what can you do to stop that? Well, you could just say, I'm just going to post everything to loan payable and not record the interest when I do the data input, and then do the adjusting entries, breaking out the interest portion in accordance with the amortization table and breaking out the short-term and long-term. And that could make your data input easier so you can memorize the transactions and then make the adjustments when you present the financial statements. That's one method that you might consider if you're doing data input, if you're doing bookkeeping. So let's record this out. I'm going to go down and do this again. And I know we're recording at the end of the month again. It's a little funny, but I'm going to say F2 plus F2 and then scroll up. We'll do this just with the keyboard. So there we have that. So now we've got total interest for the year to date and the current month, but we have a difference in terms of the activity that has happened thus far because we cleared out the year to date activity. I'm sorry, the month activity. I got to get used to this 2-column thing, but I'll start being able to talk about it more clearly as we go here. I think. Loan payable is going to be down here. We're going to say F2 plus F2, picking up that 1,063. So it goes down to the 69,878. That 69,878 should match that 69,878 on the amortization table. By the way, before we did that, it was at, I undid it, 70,941, matching what we had before. Redo it. Now it's at the 69,878, matching what we have over on the amortization table. Finally, the checking account, F2 plus F2, is going down as well. Okay, so that should put us back in balance down below. Let's post it to our GL. So I'm going to put my cursor on column K, and go to the right to EQ, right click, and then unhide. The game is over. The hide and seek game is over. It's time to post now. So let's post this first one first. Let's do them both at the same time. We'll get crazy. We'll do them both at the same time. So on the interest, I'm going to go to interest. We've got to make a new account. I put that way at the end. So I'm going to make a new account in the GL way at the end over here. Way at the end, GL, new account. I'm going to copy from the skinny over to BK, right click and copy. I'm going to put that in the skinny right here. I'm going to right click in the skinny, and I'm going to insert those cells, insert the copied cells, and we'll remove the beginning balances. And the second one, I'll just keep that one there. I won't delete it. Yeah, let's delete it. We'll delete that one. I don't need that one. We'll paintbrushy that one and just remove it. That's not what we need. And this one will be our interest one. So this is going to be equal to, left to the trial balance to pick up the name of that account, which is going to be interest expense. And then we're going to say on 2/1 and then 2/28. We got 2 transactions. We're going to record this equals left to the wall. We're going to pick up the debit up top on 2/1. And then on 2/28, we're going to do the same thing, equals left to the wall. We're going to pick up then that 296. That brings us to the 596. That 596 matching what's on the trusty TB, otherwise known as trial balance on both sides, but we're looking at the year to date with our GL here. I also need to add it to my check numbers, so I'm going to double click on my check numbers, go to the end of it and say plus, go to the right and pick up then that number that we just put there, which was the 5 696 and enter. It's also an income statement amount, so I got to put it in this number too. Double click in that number. Is that the right? Yeah, that's right. Go to the end of that one, plus, and then we're going to put it in this one too for my 2 check numbers. So it's included in my 2 checks with the double check, 2 checks right next to each other. Okay, so now we're going to go back on over and we're going to post the loan payable and the loan payable. So that's going to be our third liability account. Assets and then liabilities, loan payable. We're down here. We got one on 2/1. We got one on 2/28. So we're in cell AL17 equals left to the wall. Scrolling up, we're picking up the loan payable of the 1059, bringing us to that balance, the 70,941. Then the loan payable on AL18 for the 2/28, the end of the month, which we're basically saying the next month or the second payment, the 1063, which brings us to that 69878, which should be the amount after the second payment on the amortization table, as well as the amount on the trial balance, 89678 right there. We're not quite in balance on the GL till we record the checking account, which is going to be right here, right there. So we're in, once again, 2/1 and 2/28, 2 transactions. We are recording at the same time because our skills are mad. We're totally calm, but it got mad skills. It's not easy when you're totally calm with mad skills. Any case, that's what we got to deal with. So we've got the 88,811 minus the 1359 gets us to the 87,452 minus the 1359 gets us to the 89,094. That matches the trial balance in both sides year to date and for February. We're back in balance up top with the green zeros. So this is where we stand at this point in time. I think everything is working the way it should, even with our more complicated trial balance. Fancy, but a little bit more complicated. Oftentimes when things are fancier, they're more complicated. It seems like those two things kind of go together. But that's where we stand.